hosted by our organization, which is the NBOA. The NBOA stands for the Neighborhood Building Owners Alliance. And for those of you who don't know, we are an affiliation of 7 different grassroots-oriented neighborhood developer and landlord groups. Among them are the Rogers, going from north to south and a little bit west, we have the Rogers Park, Edgewater, Uptown, Northwest Side Builders, Lincoln Park, Lakeview, the South Side, and Greater Austin. And we are all represented as with an umbrella group, which is the NBOA, to advocate and be a spokesperson for the property owners in the neighborhoods of Chicago, and obviously being in Chicago with Cook County. So we deal with a range of, have dealt with a range of issues since our inception about 15 years ago. It's my great honor today to have 2 very distinguished and important guests, Assessor Kaegi and Chief Valuation Officer Meyer. And we're going to have a 1-hour session. And joining me in the questioning is one of our esteemed board members, Sam Goldman, who I asked to introduce himself right now.
Well, thank you, Mike, and thank you all for joining us. I'm Sam Goldman, Arbor Investment Management, LLC. We invest in properties throughout the Chicago area, multifamily and some commercial, as well as other markets in the United States. I'm anxious to join in on this conversation. I think this will be the first of many important conversations as we start to recast and rework the landscape in front of us.
That's right. Thank you, Sam. Just as a quick side note or background note, we plan on having these discussions perhaps 1 a week. The consensus I've heard is that next week we'll probably deal with a panel of lenders and get the perspective on the new landscape from the perspective of both agency lenders and local commercial lenders. And I think it'll be a very important discussion that we'll have at that time. We as an organization feel very strongly that we're a participant in trying to come up with solutions to the 2 crises at hand. There's an enormous health crisis that we're all dealing with, and there's an economic crisis which might be looming. I've said this in the last 2 sessions, I'll repeat it, but this time much more quickly. With multifamily, I think we see the point where the economic crisis and the healthcare crisis converge, with people being instructed in order to stay at home, many of them in apartment buildings that we provide. There's a great responsibility that we as multifamily owners have to provide safe and secure and clean housing and to tend to the needs of those people who rely on us to have that kind of quality housing. I salute all the healthcare workers across the world, especially in our country and locally, who are doing heroes work. We've heard about that, but I also want to suggest and assert that property managers, maintenance staff, even the owners of the smaller buildings, we're all put in this role of taking care of our residents and sometimes at personal risk to maintain safe and quality housing. And I'm proud of our industry for stepping forward and being there, and on the economic front to always, and I've yet to speak to a property owner who has not been there when residents are facing troubles and difficulties with their rent, a willingness by everyone I've been speaking to work with folks. So with that being said, let's turn to the economic crisis at hand. But in terms of meeting and getting to know our 2 guests, we have an hour. And so as part of that hour, I would like to take 10 minutes to get to know our 2 guests a little bit better. During our prep call, I learned some really interesting things about our 2 guests and their experience dealing with economic and fiscal crises in different parts of the world. And I think it's really important to know a little bit about your experiences. So I'll introduce you first, Assessor Kaegi, if you can tell us a little bit about yourself and then tell us about those experiences.
Sure. I'm speaking to you from Oak Park, my house where I live now. I've been here since 2010. I grew up in Hyde Park, where my dad has been trying to sell his house amidst this crisis. So we have some firsthand experience in the family about what that's like. So my background is, I've been in the Assessor since December 2018. I started running for the office in spring of 2017. Before that, I was a portfolio manager of the Acorn Fund, which is it's a $5 billion mutual fund invested in all different kinds of equity assets around the world, publicly traded, including a lot of companies in the industry, property industry. And before that, I managed an emerging market fund, which did the same kinds of things around the world. And I focused on sectors that did this. And I lived through a few financial crises as an investment manager, most notably the 2008, 2009, when I was managing a $1 billion sleeve of international investments and seeing markets shut down around the world, see whole areas of demand vaporized during a crisis like that, figure out how we finance, what to do with our own cash during a crisis like that. So we had to live through that. I lived through a couple of crises before that because I started my investment career in Russia in the 90s. And I was there when there was a putsch and Yeltsin's tanks fired tank shells into the Duma to put down a putsch. Saw hyperinflation there, saw them double default on their debt, devalue their currency, all the banks went under. So those are some crises that I've seen. This one's pretty different. There are a lot of differences. We'll talk about that. But just to answer your question, Mike, I've seen a couple of these different crises roll through, and we can see what rhymes, what's different, and try to think through some of these issues, especially as we see sometimes markets take some time to adjust in pricing after a crisis has started. And I think that's kind of where we are right now. We haven't seen the markets fully adjust to the conditions. Everyone's trying to figure out in real time where this goes. So this call is great because we love to hear your questions. Also, I'm sure there'll be comments about what you're seeing and hearing.
With that being said, I'd like to direct people to the chat function on the right panel. We will be monitoring this discussion on the side. If you want to address any questions or make any comments, we do keep an eye on these, and the transcript will likely be available later. And so, please feel free to comment. I think we're all getting to be experts on this platform, aren't we? So we know how to work it.
We're getting there.
Don, can you introduce yourself and your position, and the same question about your past experiences with global crisis?
Sure. I'm Don Meyer. I joined Fritz in the assessor's office January 2nd of last year. I spent 46 years as a lender in town, almost all of it as a commercial real estate lender. My longest stint was with the old First National Bank of Chicago. I was there from 79 to 97. I left there, joined a Sam Zell chaired mezzanine finance company. I ran the mortgage banking platform for Cohen Financial for a couple of years. I ran a Fannie DUS platform for a couple of years. In 08, the firm I was with collapsed, and my partner and I started a bank consulting company to deal with problematic assets. I graduated from the University of Illinois in 72, and in 74, the Saudis raised the price of oil from $3 a barrel to $12 a barrel. That created a real estate crisis. In 81, 82, prime went to 20%. That created a real estate crisis. In 90, 91, 92, there was another crisis. I ran real estate workouts at First Chicago at that time. I spent every day of those 2.5 years running workouts there saying, today we start up because it couldn't get worse than it was yesterday. I was wrong every single day for 2.5 years until it finally started to turn up. I went through 08, started a company from scratch because I was 59 years old and the company I was with had collapsed, and people weren't standing in line to hire a broken down 59-year-old and and we ended up working with a number of banks around town to deal with their problematic assets. And then one of our clients were the investors that recapitalized what is Byline Bank, and I ran lending at Byline Bank for those 6 years prior to retiring from the bank at the end of 18 and joining Fritz in the assessor's office as the chief valuations officer. And in that function, I'm responsible for managing the group that sets the assessed value on every property in the county.
Thank you. I really do think that your experiences dealing with those type of situations are deeply relevant and helpful to know that you have those experiences. I imagine what we're seeing now is really unparalleled, wouldn't you say?
Well, like Fritz said, I've never seen anything like this, and I saw gas waiting lines in the 70s. I saw prime at 20%. Now we've got 16 million people have filed for unemployment in the last 3 weeks.
Yeah, and I think, you know, the crises that I've seen have mostly been driven by speculation or supply getting ahead of fundamental demand, financial disruptions. There is financial disruption to the crisis here, which I'm sure many people are familiar with, but the fact that the crisis fundamental cause is the pandemic, where economic activity has to stop immediately, and stimulus is not there to offset that, or stimulus is not there to get people back out shopping. Stimulus is there to provide support so we can all ride through this crisis. That is a fundamental difference. And then the longer term impact of how does the perhaps multi-year presence of COVID-19, what does that mean for anything, business or activity that requires physical presence or tourism or things like that? That is something that is very different here.
So, Assessor, I've known you ever since you first ran for office, and as I've seen you adapt to the office, you've certainly been an object of controversy and of appreciation, but also deep, controversy, and you've been very transparent and been out there explaining your positions. And I concluded this guy's got a pretty tough job. But however tough it was a month or two ago, it's pretty much a lot tougher now. You're making some important announcements. Would you like to share with us the latest from the perspective of the Cook County Assessor's Office?
Sure. I think the most important thing to know is that this is the year where we reassess the South Suburbs. We had started sending out assessments that reflected the state of the world as of January 1st. And then the crisis began to unfold. And we know that this crisis does have an impact on valuations, that this is something that certainly can be reflected in people's appeals. We feel like we have a duty to, as best we can, capture what things look like post the emergence of COVID-19, at least in the early stages. And so what we did is we made a decision to say, look, we're going to stop sending out new assessments, take stock of what's happening here, and if necessary, redo the assessments for the South Suburbs, taking that into account. So what we're doing is that we will be, for the towns in the South Suburbs that have not yet received notices, the assessment notices that they get will reflect our estimate of the impact of COVID-19, and we will be explicit in how we came up with that estimate in those areas where they're receiving the notice for the first time. In towns that have already received notices, we'll let the appeals process continue. Once it's closed, we will take into account everything that we've received in appeals, and then also send out assessments that reflect that same COVID-19 adjustment that the rest of the South Triad gets. And we will be as granular as we can. We're working off of data that we realize is just starting to emerge. Markets are still trying to discover prices. We'll do it as best we can based on what we're seeing in the market today, in brokerage activity and buying activity, pricing activity, what we're seeing in REIT markets, which are in real time, pricing in different expectations and cap rates. We'll look to see what patterns and relationships occurred in past crises, and try to figure out what could some of the differences, unique differences from this crisis mean versus past experiences. Those are the kinds of things that will inform the way we try to take into account a COVID-19 effect in our assessments. Our job, after all, is to take a snapshot of the price of real estate and better serve that we try to take into account COVID-19 rather than act as if nothing had happened. In terms of what does that mean for the non-tri-towns, so Chicago in the North Triad, what we will do is we will take in appeals. This is a period when we're not traditionally reassessing. So when we'll take in appeals, and then based on what we see there, what we're seeing in data in the market, we will try to come up with an adjustment to overall assessment level in Chicago in the North Tri. We are still at the early stages of figuring out how granular this can be. There was in 2008, 2009, the assessor's office did make a factor adjustment to all parcels in Cook County during that financial crisis. That's one approach that we could take. This is still at an earlier stage. The greatest limitation on our ability to do this is time, data, our own personnel resources, and our IT resources. So those are big constraints. I think that was a big reason why 2008, 2009, the assessor's office just did a broad brush down factor for all asset values in Cook County back then. But we think that we are, again, doing our job better if we try to have some sort of adjustment of effect for COVID-19, then do nothing, then assume nothing at all happened. Because if we did that, some folks have grounds for appeal if economic circumstances have rapidly changed, as they have. But a lot of other people who are not appealing would not have the benefit of that. So we wanted to have, if there's some adjustment that can be made for everyone, we try to measure ourselves by how are we doing for the average person who doesn't appeal. We thought that's the right thing to do. And we will keep people informed for how we do that and what is the math and assumptions behind that as we do it. I think the last important thing to know is there are a couple of other important things to know. First of all, coming up, we have the exemption deadline. So anyone out there who has, I know we're talking to multifamily group here, but you should just get it out so people know that exemptions need to be in by the end of this week. That affects your tax bills this year. Any assessments that we're doing this year, reminder, that only affects your taxes in the second half of next year. We don't have any statutory authority to change tax deadlines. We think our role in all of this is to make sure that the property tax system is functioning. I just remind you that who's on the front lines for turning around COVID-19? It's our local hospital system, and the chief safety net hospital in the county is the Cook County Hospital. All the public authorities are financed by local entities, state entities. The property tax system needs to function so that they have financing to do this. So we see our job is just to continue doing these, performing our role on time, on schedule, so that we hope that the federal government will be providing more firepower. It has very unique firepower in terms of liquidity and dollars to backstop in a crisis like this. But if there's not a full backstop for the state and local entities who are doing this, the property tax system has to be there to function. The last thing, I think we'll talk more later about how in the assessment system can we be flexible to the circumstances as they're emerging. I think a really important topic for this call is we know that that multifamily owners they have tenants that are facing real economic distress here. How can we, there are a whole welter of programs coming from Fannie and Freddie, from other agencies to provide forbearance on the mortgage side as the crisis flows through. What we want to do is we know that the tenants and landlords will be working together on modifications, on forbearance of rent, and we want to make sure that we're taking that into account in our own assessment. So as part of the real property income and expense form, as part of the appeals process, we'll be taking information about rent modifications where the landlord and the tenants will provide information or affidavits to that effect, and then we can take that into account in modifying the assessment.
Now, Assessor, if I may, on that point, because an area of concern I've seen from many of the folks on this call is many of whom attended your seminars and lectures and other events last year, is we heard that your office was shifting to a mass appraisal approach, and that the individualized data that we were to submit via the income and expense reporting would not be used to assess our individual properties. Now I'm hearing that that data is going to be used to provide relief. What is the plan with that?
Well, Sam, there's actually not a mutual inconsistency there. So first of all, when we were talking about, first of all, the office has always, in theory, used mass appraisal to value because there's no alternative. There's 250 people trying to value 1.8 million properties. So our office, in fact, has always used mass appraisal. It's just not been very good at it. And the way it would solve problems in the past is through the appeals process, get people to submit basic information so that you could get assessment closer to the level that it ought to be. That's how it was supposed to work. Now, last year when we were talking about anonymized information, that was in the context of the data modernization bill, where if everyone's required to submit some basic rent and expense information in that context, that does need to be anonymized, and it would help the mass appraisal process to do so, because then we could get these numbers right before appeals start. It would be very useful in this circumstance, for example, to have that more data that's more fresh and real time when we, like, let's say rent collections are down 10% this year. The RPIE would give us that insight immediately without having to have recourse to the appeals process, and we could take that into account immediately without having to use the appeals process to get it. Now, the appeals process is the second backstop in all of this, because the mass assessment process gets stuff wrong. It's 100% the case that you know more about your property than we do. And so when you make an appeal, that's where you can present that information to us, and we can use that information about your specific circumstance to do an even better job than that first cut of the mass appraisal would do. And I think a situation like we have with COVID-19 is a perfect use of that. We know that in some neighborhoods, there may just be really dramatic rent modifications that need to be made because half the people in the building lost their jobs and don't have more than $500 in their bank account. And so if there are rent modifications and forbearance being provided by the landlord, that affects the valuation of their property, that affects their collection rate. That's the kind of thing we should take into account. But that's a perfect thing for us to ask and for someone to present on a property by property basis, and we'll do the best. So I don't see them as inconsistent. I see mass appraisal, you have a duty to be accurate and preserve anonymity if people are mandated to submit information. It also helps transparency and predictability when you have that kind of process. But then when you have an appeals process where someone is voluntarily submitting information to get a benefit coming from an office, then there's less expectation of privacy, and actually the person who's submitting the information says, look, I want to tell you about my circumstances here. Take these things that you don't know about into account. We want to do that. We don't want to be proceeding blindly and fatalistically, regardless of better information that's given to us. Does that answer your question, Sam?
I think in part, in another area of concern, I think everyone in the room would like to understand, absent factor adjustment to all parcels or some twist on that, which we can discuss this question of shifting between the retail, commercial, and multifamily where everyone's hurting right now. How can the property owners, be them homeowners or apartment building owners, owners of other commercial properties, how can they expect to go about attaining assessment relief because of hardship they have suffered due to the COVID crisis, be it through granting forbearance or other rent relief to their tenants or other issues?
So in all parts of Cook County, whether you're in the South Triad that's being reassessed now or not, you always have a right, if your assessment does not reflect the economic circumstances that are prevailing out there in the world, to appeal and tell us about, say, look, I'm overassessed because I own a performance space whose economic value is dramatically impaired here, and you need to modify the assessment to reflect that. That's why the appeals process exists, and that's the way we can accommodate that need in circumstances like these. So because we know, especially in Chicago, which hasn't been reassessed since 2018, that some circumstances will be dramatically different. And that's where, since we don't reassess this year, the appeals process is how we can do that. We will have this factor adjustment that tries to get us part of the way there for everyone. And that's intended to help the average person who doesn't appeal, to get us part of the way there, to help everyone without incurring any legal costs that come from the legal process. But we know over and above that, folks out there will have grounds for saying that they've been overassessed because of changes in dramatic changes in market conditions.
Along the lines of vacancy is another question I'm seeing a lot in our chat box here, and I've heard from many others. It's been our understanding that your office was planning on moving to more of a uniform application of vacancy, where you were using a market average occupancy. But today we're looking at, different aspects of vacancy. You've got economic vacancy, which is a huge factor right now. The tenant's there but not paying. You've got physical vacancy, the unit's not occupied, or on a commercial retail standpoint, the doors are shuttered. You also have physical vacancy due to construction or perhaps delayed construction. How are you looking at these factors? Are you going to look at these on an individual basis, or are we going to apply a market occupancy factor?
We are just in the processes of rolling this out. Don, do you want to talk
Sure.
about how we'll be treating this?
Sure. Let's start with where we were in January, when we thought this was going to be a normal year. We were revising the previous vacancy practices of the office to do two things: adjust for market vacancy that, if you will, existed at the beginning of the year, which is our normal assessment cycle, and also at the same time to recognize that vacancy above the market level of vacancy is not if you will, a permanent impairment of value. It should in fact be a temporary cost that the property owner is bearing, and we were revising that policy to reflect that reality. About the time that we were ready to roll that out, COVID-19 was overwhelming the realities of the marketplace, and we have been working through and thinking through the issues. How do we reflect the reality of the wide-ranging kinds of vacancies that exist, that frankly, I never anticipated that we'd have a situation where the governor of the state of Illinois would say, everybody stay home, and unless you are a business selling food or medicine or gasoline, close your doors. We believe that level of vacancy is a impact on value. We're trying to work through in our analysis the reality of that impact in value. We're also trying to recognize what we believe is a reality that impact in value is not going to be permanent. I mean, the economy doesn't function if that's permanent. So we have to base an analysis which says those levels, those kinds of vacancies driven by operations closures is a temporary phenomenon. Do we have all the answers as we sit here on the first week of April? No, we don't. We know that we have to come up with them very quickly because we need to start mailing towns and resolving values. And we are reaching out to a wide range of organizations that do significant research, governmental agencies, universities, looking for research papers from wide-ranging real estate organizations, respected real estate organizations, to try to get our arms around it and come up with an assessment, if you will, as of the spring of 2020, which is so very different than January of 2020.
Yes, it sort of gets to the broader question, and I think a lot of us are reevaluating our view of economics in the world today, and we simply don't know. But just getting back to this idea of individualized versus mass appraisal. I have two commercial retail parcels across the street from each other. The buildings look the same. However, one is a liquor store and one is a shuttered tavern. Is there to be, at the end of the day, some type of relief granted to the shuttered tavern relative to the liquor store that's open?
We are going through in our research right now and in our analysis trying to identify those property types that will particularly struggle longer term versus those for whom it's going to be a transitory phenomenon. As we look at it, grocery stores, everything else being equal, seem to be doing great today. Warehouses, particularly new institutional quality warehouses, everything else being equal, are doing great today because there's a tremendous demand to have inventory to deal with, I'll just use the term hoarding, that households are engaging in. You can go to the other end of the spectrum, and that corner tavern is going to have a very, very different experience than a Mariano store or a institutional quality warehouse. And we are doing our best to recognize that reality. We believe it is real. Our ability to distinguish at that granular a level, or to distinguish that corner tavern from the liquor store across the street is something that we are more able to do in the south suburbs than, frankly, we're able to do in the city or the northern suburbs. So we're trying to put all those issues together under time pressure. And while Fritz says there's 250 people in the assessor's office, and that's true, 95 of them are in the valuation section. So we understand the issue, we are sensitive to it, and we are doing our very best to identify how to reflect those values. But it's very, very, very challenging.
Yeah, and Sam, just to build on what Don was saying, we always have to remember here in our duties here at the assessor's office is to assess the value of the real estate rather than the underlying business, which is not our job, and it's improper to us to inquire as to the profitability of the business inside the real estate. We need to think about what would a reasonable buyer pay for the real estate and based on the potential earning power that they could get out of it. So it's in a situation with the tavern, it's hard, what are the alternative uses for that building versus another kind of use. It's something we need to think about. But when for a landlord, if the earning power of that location is significantly diminished because they don't have that tavern usage there, that's also something we need to think about.
And I think that this will be a great conversation for another call here as we evaluate the alignment of those with the means to pay with the need to pay. As we all know, we're a heavily property tax dependent county and state.
Yes.
And,
Yep.
and if we have the bulk of that numerator allocated to properties that simply cannot pay, we're going to have our own set of issues. I did want to cover a couple of questions we have from the crowd. I think functionally, we've received a few questions that deal with the impact on deadlines. I'd like to just understand generally, are you going to hold to the existing deadlines? And B, I'd comment, I noticed in the Sun-Times article the other day, it seems that the period for appeal is being somewhat shortened, and is it true that re-review has been eliminated? Can you address all these?
Sure, let's just take those questions in turn. Remembering that the assessment process is just one part, at our office, it's just one part of the overall property tax cycle. So as the article mentioned, as I mentioned in the call, we don't have the ability to change tax deadlines because we don't determine taxes or collect taxes. The property tax code of our state decides on the deadline for collections. The county treasurer sends out the bill and collects the tax dollars. And then remember that on the other side of the receiving end of those dollars are frontline defense against COVID-19, all the hospital system, public health system, everything else that the city and county and local government is doing to turn around, to provide stopping power against COVID-19. So they need those dollars. So even if we could decide to move the deadline, it's not like the federal government, which is getting wage withholding on a monthly basis, has ample liquidity. A lot of these local governments don't have that kind of liquidity. They don't have alternatives. So we see our duty is to perform our job to the best of our ability under the circumstances on time, so that then other parts of the chain can do their job. So we finish our assessments. We should be wrapping up our assessment work for the next cycle by December, hand off our work to the board review. They do their work. Then the county clerk does their work, and then the county treasurer does their work. And the assessments that we do this year would affect people's tax bills in the second half of 2021. So that's what we can say about deadlines. Now, in terms of appeals deadlines, we've moved. First of all, we on those towns that we sent out assessment notices to in the south suburbs already, we suspended the deadline because we knew that we likely would be taking into account COVID-19 in our work. And so for those towns that have already received notices, the appeals deadline will be moved back. I think it's to May 1st. Then we will take, once the appeals are done, then we will do a reassessment taking into account COVID-19 for those areas and the information we got in appeals for those towns that already received notices. For the other towns in the south suburbs, we'll send out a revised schedule to be available on our website. Now, because COVID-19 has cost us 3 weeks, in altering our operations, moving to virtual operations. We're trying to be nimble to do our part to get everything in by December. We have to figure out how do we buy ourselves some time. And so what we did is we're cutting the appeals period by 40 days. We actually grew the appeals period from 30 to 40 days. Originally this year, we're going to cut it back to 35 days. And we won't have re-review, which is not statutorily required. That still lets us get our job done on time. People have recourse if they're still not working. If we're not getting the number, if we've not gotten it right, if you think we got it wrong at the assessor's office after the appeals process are done, there are other avenues for appealing beyond that. In a difficult world with bad choices, we thought that was the best choice we could make.
So to be clear, it will be a 30-day window for appeal, and re-review is not going to be available to
35 days.
35. Okay.
35 days.
And then one last piece, we had a question, a specific question from the crowd here with respect to Oak Park Township. Apparently the online filing system shows that appeals are being accepted till May 29. However, the written materials show May 1. Is there a reconciliation of that?
I don't know the answer to that question. We could get back to you. We could send an update to all the participants on the call or members of your association.
I can actually jump in on that one. This is Scott Smith. I'm the Chief Communications Officer. It's an error in the online appeal system. It should be corrected today. The actual deadline is May 1st.
I think it might be helpful, just as a suggestion, if the assessor could put out a single statement on their site, perhaps a PDF or a page, just to review all of these appeals deadlines, not only for the professional property owners on this call, but for individual homeowners and folks who have a lot of other things going on in their mind, and it's tough to keep track of this.
I agree.
I've actually got
I had a conversation about this last night.
Wonderful.
I've actually got that posted in the chat if anybody wants to take a look at it. The assessment calendar and deadlines, as we know them right now, are posted online, and we'll be continuing to update that as we get this resolved.
Very good. I think that's an important link we'll be pushing out as well from NBOA. Mike, I know you had a couple of items, and we want to make sure we cover everything here in our limited amount of time.
Yeah. I also looking at the question board, and I want to ask about your recommendation for best practices for smaller multifamily owners and larger ones. I think there's some question when it comes to our 2018, 2016 to 2019 schedules of income and expense. Are they really as helpful in providing the data you need? Would you be considering and looking at 2020 real estate tax appraisals as an indicator? On the question of appraisals, I've been asked to throw a question as to whether inside inspections are still would be required, as I think they were pre-COVID. And beyond that, questions of best practices that you were starting to get to earlier about us providing affidavits of vacancies or of modifications. What should we be thinking about as we move forward, both the small and the larger property owner?
Okay.
How about I cover the best practices, and then Don, do you want to get the other bits there? In terms of best practice, the fundamental part about our job that is so hard is that you have an incredibly diverse stock of real estate in our giant county. It's the biggest market-based assessment jurisdiction in the United States. And because we don't have that data modernization bill framework in place in this state that is in place in so many other parts of the country, we don't have the ability to do income and expense collection the way it ought to be done. So in absence of that, we use third-party data to try to assess what market rents and market expenses and occupancy are in places as granular a level as we possibly can, so that we're reflecting the reality that you all live. But that third-party data is flawed. It doesn't have a comprehensive coverage. It tends to skew to the higher end assets, the higher end neighborhoods. It tends to skew to the newer, bigger buildings. It tends to skew to the more professionally operated buildings that are better at sweating the assets. It tends to skew to newer buildings that are lower cost to operate. The data that is really valuable to us that's needed that for small buildings is how much higher costs do smaller buildings have. That's like one of the most important things. When we make mistakes, it's oftentimes on costs. And we know smaller buildings have costs. We know smaller buildings, older buildings, buildings in neighborhoods that might not be top priority for CoStar, the costs are higher, but how much higher are they? That's the kind of thing that's really useful that we try to collect as a best practice to reflect the reality that we all live. And that can be really helpful in helping us deal with assessments in a crisis like this, because we know it won't affect rental housing equally. Folks who have a big 200-unit building that is institutional quality are going to have a very different experience with rent modifications and collection than the person who has like you guys, you have a picture of a beautiful garden apartment building on your website. Imagine that building in McKinley Park or Austin. The folks who are living in that building are going to be, or the typical tenants for a building like that are going to be much more economically affected by this. You're going to have to do more modifications, there'll be more trouble collecting. Cap rates will blow out on those in the market. Our ability to differentiate on that helps us do a better job, but we need the data to do it. We drive through the rearview mirror with third-party data. It's not going to be as good a job, and that costs you money. It's expensive for us to administer, and we don't feel like we serve the public well and you well when we're inaccurate.
So what do you do as a McKinley Park owner of that building? What do you suggest?
Well, what I suggest is submit the real property income and expense form to us. If you are having experiences this year with COVID-19 where you have to modify rent arrangements with people, tell us about that in your appeal too, which you have to fill out the RPIE form, but we'll have another form for COVID-19 related experiences. That is helpful. And then let's all work together on making sure we have good data so that we don't have to cost you money and time to solve this through the appeals process. Let's try to get it right so we are in a position to get it at the outset, be accurate in the outset, and be more nimble in a crisis like this without having to lean on that rickety appeals machinery.
So go online, you're suggesting, and submit.
That's right. So the real property income and expense form is there so that we can have a better insight as to what are the circumstances that you and properties like yours
With affidavits of adjustments that we make with our tenants. And
yes, so we are building the framework for this now, but what we will do is we will be asked, and actually you can help us with this. We want to know, are we asking the right questions so that we're capturing the full spectrum of how your earning power as a building owner is affected by the crisis? It might be rent modifications, it might be free rent, it might be other things that we haven't thought of. Make sure we ask those questions so the data coming in at the funnel is useful. And then we want to have you and the tenant working together on this. We think it's very important. I know, Mike, you and your members are, you want all government participants to have, be reinforcing that message of us working together, have tenants and landlords working together to solve this. We want to be part of that. And we think having this process where it's part of your appeal, you and the tenant can certify to modifications that have been made. We can take that into account in our assessments. That helps to build cooperation between tenants and landlords. We think that slots in really well with the forbearance policies that Fannie and Freddie have rolled out. I mean, they rolled out this policy that says, hey, we'll forbear mortgage collections for 3 to 12 months if you don't agree to evict. And if we have a policy like this that slots in with there where you guys are duly stipulating to modifications, that keeps people in place, helps us solve the crisis, helps us assess better, and doesn't lead to bad outcomes where we have foreclosures or evictions.
Don, we had a question about appraisals.
Right. So, the question of should you provide operating statements from 16, 17, 18, 19? Absolutely. We are, as I said earlier, we're looking to make judgments on what are longer term impacts on value, what are shorter term impacts on value. We don't believe April of 2020 is the new permanent normal. We have to make the long-term assessments, and that historical information is necessary. Go ahead.
No, go ahead, Don. I'm sorry.
In terms of appraisal standards, we've been very clear since Fritz took office. We're looking for USPAP compliant appraisals. And we are looking for USPAP compliant appraisals in 2020.
And USPAP emerged out of the.
Go ahead, Fritz.
So Don, yeah, USPAP emerged out of the S&L crisis. It's a congressionally mandated standard that served our banking system well, and Don knows it well, and that's why we require it.
Right.
Now, we are getting a number of, on the subject of appraisals and submissions of accurate data, we've seen a number of participants in this meeting raise concern about the 5/1 appeal deadline. They're not physically able to get in to inspect a lot of these properties and provide that data to you. Is there any thinking or thought that you might rethink the ability to submit that later on down the line?
And this is just to help me on the inspection part. So this is if you're a building owner that you can't inspect the property. I just want to make sure I understand.
No, the appraisers are not active right now. You won't be able to get that USPAP appraisal. You're not able to see the smattering of units as required. There's a lot of impediments going on right now.
You know, we don't require appraisals with appeals. What we require is information and data to make an informed decision. Frankly, reliable data, reliable information across the universe of properties is more valuable than an individual appraisal anytime.
And again, we're in it. We have to remember that we're not in an ideal world here, where we have a lot of bad choices. We have to make an assessment at some point. We have to be able to manage our schedule in a way that that gets the job done, distributes the appeals time equally amongst all the different jurisdictions in the county, does our job as part of the whole property tax cycle with other participants. We don't want to, for our benefit of maybe getting a 1% incremental improvement in appraisals, have that come at the cost of 2 months of time where tax bills either delayed or the board review has to work all out. We're living with constraints here, and we think that this is the best that we can do with the time and resources that we have.
I didn't intend to editorialize, but I would encourage you to consider that. Off the top of my head, and I saw another participant in the chat, very adeptly observed, owner-occupied commercial properties oftentimes require an appraisal here. It seems somewhat prejudicial to certain of the townships.
Well, we could explore taking appraisals that someone would have given their bank or lender earlier on, that's maybe not done as of the most recent month, but that was given your lender further back. This is something we can explore. It's just we don't have much flexibility on the timing.
When can we expect to see the COVID-19 form? That's a last piece that we've seen a few questions on. Is that going to come out soon? Is it in development?
We don't have a specific time where we can release it to you. We talk about this daily amongst us as senior leadership of the team. It has to run through a couple different traps in our operations. So we need to talk it through valuations. Do they have the information that our analysts need and can use? We need to make sure that on our IT team, that our systems can handle it, process it, and be manipulated in a way that's useful. Our legal team has to make sure that it is satisfying all the requirements of our property tax code and Illinois Constitution, federal Constitution. And then also has to go through data science too, because they're part of the valuation process. So it requires a little bit of coordination. I'd say, it will need to be available relatively soon so that everyone can take advantage of it. But remember that COVID-19 appeals still have, this affects taxes for next year, so we have some time to work.
Listen, we're down to the wire here, but I would like to, if we can have just a couple more minutes. I think you have an incredible task ahead of yourselves, and we share that task with you. At the end of the day, it's all about tax rates. And that's, I presume, a big unknown, but I would think, and we discussed this prior to the call, the ball game comes down to federal help. Can you speak towards that?
Definitely. All of us here, all of you here are, you care about assessments in general, but you really care about how you're assessed. And that's true of everyone else. But assessments don't change the fundamental picture of how much dollars have to be collected in our system. And it seems like, I think a lot of the conversation, we rightfully are having a conversation about, is everyone being assessed properly here? There's been other conversation about tax deadlines, and can we move deadlines? Can we waive deadlines? Can we waive fees? That also is not going to solve a fundamental problem of taxation and the rates that people face. It just kicks the can. And I think all of us as citizens, if we want true property tax relief, which I do, I think the way we pay for government and the level of property taxation is very injurious to people whose livelihoods are living here and doing business here through physical assets. If we want to get property tax relief, we really need to focus on making sure that the federal COVID-1 relief package and other legislation is out there providing property tax relief. So the CARES package that was passed in March, it does double Title I K through 12 education funding, which is good. Schools drive 2/3 of the property tax bill. For each amount that Title I is doubled, that in principle can lead to a 10% decline in the education property tax levy in the city, and even bigger elsewhere. So that was good. We need to get more of that in any additional aid packages that come. Similarly, any backstop that's provided to state and local governments in the federal relief packages will be very important for how it translates into property taxes here. The CARES package that was passed in March had $150 billion for state and local government. Give or take about $5 billion will come to Illinois. Out of that, about $2 billion will come to Chicago. That's good. We know many sources of revenue are really going to be impacted by the city of these other local governments. And the more, every dollar that comes from the federal government that helps to backstop state and local spending on things like COVID-19 while their revenues are disappearing, while their pension assets have been diminished, depleted by financial markets, that's one less dollar that needs to be levied, because the way all this works is state and local government, if they're not getting revenue from other sources, they can't cut costs anymore. They levy property taxes, and we want them to provide the services that we're doing. We don't want them to lean so heavily on the levy. So let's all use our efforts to make sure that the federal government is backing us up in providing revenue sources other than property tax levies for all the state and local government. So that was the other thing we were talking about that I wanted to say. We need to really push hard for this in, you know, in all our contacts with federal policymakers, because no place has more riding on this than Illinois. Our property taxes are amongst the highest in the nation, very high in Cook County. They're extremely ruinously high in a lot of communities that don't have much of a property tax base, especially in the south suburbs. So we got a lot riding on that, and we need to strike while the iron's hot, and that's right now.
I'd like to assert that multifamily contributes mightily to the property tax system, and it reaffirms the dramatic importance that public officials convey to the electorate, the importance that they pay rent. We will work with tenants, everybody I know is, but the underlying responsibility goes beyond the safety and security of a building, but to support this very important backstop to keep our government functioning. Do you agree?
I agree, and I just, anyone who, you know, I think we should all recognize that all the different forbearance policies, the policies that we have, the tenant ordinance that's in the city, all of these things push towards cooperation between tenants and landlords. All the incentives are there for cooperation between tenants and landlords. You know, these Fannie and Freddie forbearance benefits, you know, the Fannie and Freddie are providing 3 to 12 months of not having to make payments on your mortgage if the landlord agrees not to evict. Now, that's a good choice for a landlord if on delaying those mortgage payments, if they can make modifications with some of the tenants. But if none of the tenants are paying rent, then those Fannie and Freddie benefits are worthless, and they won't take them, and they will evict. Similarly, you know, if you know, tenants and landlords can work together on making modifications to rents as are needed, and we're taking that into account in our assessment process, that provides some incentive for folks to work together. But if people are not working together, then no amount of assessment benefit will help a landlord, and they will evict. And so we're, you know, we think there are good benefits out there that all sorts of different levels of government are providing for tenants and landlords to work together, so that we can ride through this crisis and make sure that everyone's taken care of without getting really undesirable outcomes that are harmful.
Thank you very much. We realize that with the hit to retail, you got many components, many sectors to the real estate market, and it's going to present challenges, and we wish you luck and wisdom and strength to take us through this process. Thank you guys, gentlemen, so much. And we will continue on, and we have some really important information in the chat room. I'm sure you and Scott will be able to review what have been other issues that have been on people's minds. So have a great day, and thank you so much.
Hey, thanks everybody. Really appreciate the opportunity. We'll be happy to come back whenever you like us.
Okay, great. Thank you. Okay, take care.
Thanks all. Bye-bye.